Let's go right now to the markets and your money. Joining us now, our first guest today is Megan Horneman, Verdence Capital Advisors Chief Investment Officer. Also up early, Megan, and we appreciate it. All right, from where you sit on your perch, what do you think is going to move this market? The CPI did not do it today. We've got the producer price index out a little bit later today. Corporate earnings pretty much wrapping up for this quarter. A couple left to trickle out. What is number one and number two on your radar right now?
The Fed is our first one. The Fed is going to come out in the next couple of weeks. They'll have their meeting in September. I think the market's getting too optimistic about this Fed and what they're going to do in the coming months. I think that they're still very hawkish in their comments. And I think the market's got to realize that even though that inflation data came in as expected yesterday, as expected isn't good enough. We still have a long way to go to get to that Fed's target. And I think the market is just getting a little bit complacent here on what the Fed's going to do here in the coming months.
Well, we got 34 days left until the next Federal Reserve meeting. I know that because I poked around at the CME FedWatch tool right before you came on, Megan. If that was in my head as like a daily thing, I would just retire right now. But 34 days until that occurs. So we got a long time and a lot of data. Do you think there's a chance that Warsh and crew raise rates at the next meeting, Megan?
I still think that's very much on the table. I mean, in my opinion, I think they should. I think we've had 63 months now of the inflation not at the Fed's target. Whatever they're doing has not been working. I know that you're looking at the numbers that are slowing, and that's great. But look at where we are. If you look at that absolute number, it's still way too high. And it's not just the inflation data that's too high. Look at some of the other factors that are going on. Liquidity is so high right now. We're looking at stocks at a record high. We're looking at bank lending conditions that are easing. The real Fed funds rate is not really in restricted territory. So there's a lot of liquidity out there in the system that the Fed really has to look at because this is all inflationary. This is not going to work to get it down to the Fed's 2% inflation target.
Megan, for an investor, what are the takeaways there? If in fact you think that inflation is going to be more persistent and or the Fed might have to move more aggressively to restrain it. What does it mean for stock valuations? What does it mean for how bonds might behave?
I think the first thing is that the earnings growth expectations are at risk. Earnings growth expectations for this year, for the remaining quarters and next year is very high. I think it's pricing in a perfect scenario here where the Fed is maybe raises once, doesn't have to raise again. Everything works as, everything continues as the economy continues to grow. I think that the earnings, there is a lot of room that earnings expectations could come down. That's a big risk that we have here. From a valuation perspective, higher interest rates typically the tech stocks, they don't like higher interest rates. So you have to be careful there from that perspective. From a fixed income perspective, also, don't forget about bonds. Long-term bonds right now are a big risk in our opinion. Look at the 10-year yesterday. We had an auction, the highest yield since 2007. Look at the 30-year that's going to come out today. That could come out at the highest yield since, I think, 2001. So from a valuation perspective, be very careful here. Make sure that you're not heavily weighted in some of those high PE stocks. Make sure you don't have a lot of duration in your fixed income.
Going back to your point about the interplay between inflation and earnings growth, so much of the earnings growth stems from technology, which historically has been less inflation sensitive. Do you feel like that's different this time around?
If you look at this earnings season, it was really two companies that resulted in that huge earnings surprise. So I think there is room that if you're talking about earnings, they did broaden out. I do agree with that. But the fact of the matter is when you have two companies that have resulted in that, 50% year over year earnings growth, you have to be careful because if one quarter that they don't, satisfy those earnings expectations, then you do have a lot of volatility there. But I think there's a lot of other sectors that are at risk. I think from the CapEx spending perspective as well, from technology, you have to be careful. This isn't going to last forever. We don't know when this is going to turn. We don't know exactly when this is going to peak, but this spending pace isn't going to continue forever. And investors are going to get a little bit more concerned that they can continue to produce this types of earnings growth, not only from technology, but from some of the other sectors as well.